And you had said that prospective discount window borrowers would be discouraged from using the facility if their identities were to be disclosed. But a recent Wall Street Journal article described how the share prices of Citigroup and E-Trade Financial Corporation actually increased after the public learned that they received government support. So I'm wondering how those circumstances would differ.
I think the concern on many of the facilities is that they are used by healthy institutions to try to unfreeze some of the market. So, for example, our commercial paper funding facility, the borrowers in that facility are not troubled institutions. They're institutions that are trying to restart the market for a commercial paper. The same with our TALF facility, where we're trying to restart the market for student loans, for auto loans, for small business loans, for credit card loans. And the investors and the borrowers in those markets are regular market players. They're not troubled institutions. The concern is that borrowers in those facilities, if their names were disclosed, would be viewed by the public incorrectly as institutions that are troubled. Because we have also lent in other ways to troubled institutions. We have lent to Bear Stearns, and we did do the AIG loan, clearly troubled institutions. And so because we do help troubled institutions and those that are not troubled, the concern of those that are not troubled is they'll be lumped in with the troubled ones. That's the reason. It's the market prices would not necessarily go up. Market stigma would in fact happen.
Section 13.3 of the Enabling Act and the powers with the Federal Reserve, there has been some disagreement from individuals on whether or not this was the first time that the Fed had opened the discount window to a private investment bank when it opened it up to Bear Stearns. Was that the first time, or did they open it up prior in the late 1980s?
So the Federal Reserve opened 13.3 during the 30s, but not to investment banks in the 1930s.
In the 1980s. In the mid 1980s, there was.
It never opened the window in the 1980s to anyone. The next time that it made the 13.3 available was actually the 1960s, but that was all to thrift institutions. It didn't actually use the authority again until right before Bear Stearns with the TSLF facility and then the Bear Stearns loan. Those were the same week.
And I'm sure you understand the concern that we have as members of Congress as we looked at the extraordinary actions that the Federal Reserve took in regard to Bear Stearns, in regard to the investment banks, and then, of course, looking at the TARP. And one thing that I've wondered is whether Congress shouldn't, in fact, revisit and tighten up the language of 13.3. When you read the language of 13.3, the Federal Reserve seems to have the power to do virtually anything it wants to do with no restriction whatsoever. Would that be a prudent thing for Congress, do you think, at this time to take up and tighten up, if you will, or maybe pull the leash on the Federal Reserve on the actions it can take with the taxpayers' money?
So 2 points there. One is I'd like to point out that 13.3 lending to specific institutions like Bear Stearns, AIG, Citi, and Bank America, for example, are subject to GAO audit, which is just to make sure that that is clear. But then whether the Fed should continue to have 13.3 authority, our chairman has suggested that if resolution authority were enacted, so that the government would have another tool for implementing, for passing on the risks to shareholders and creditors, and the government wasn't left with the choice of bailing out or bankruptcy, then that would be an atmosphere or context where some revision to 13.3 may be appropriate.
But what
the gentlewoman's time has expired.
Thank you.
The gentleman from Colorado, I did want to make one point. Earlier, the gentleman from Georgia talked about hearings. I interpreted that as some unhappiness with the record. He assured me that that was not the case, that it was talking about going forward. But I did check, and according to our records, there have been 28 appearances before this committee in hearings by officials of the Federal Reserve, the chairman more than anybody else. But in the last calendar year, we have had 28 appearances by officials of the Federal Reserve. The chairman other members of the Board of Governors, and other officials. Gentleman, Colorado is recognized for 5 minutes.
Thanks, Mr. Chair. Just, I need a primer or whatever on the Federal Reserve. Remind me how many Federal Reserve banks there are.
There are 12 Federal Reserve banks.
And how many governors are there per bank? Or is there one governor per bank and then a board? Or how is the structure, the decision-making structure set up?
In Washington, D.C., there is a Board of Governors that has 7 members. Right now, we only have 5 of those positions filled, but could have 7 members. Each Reserve Bank has one president for the Reserve Bank, and then a Board of Directors, and this is set by Congress, a Board of Directors of 9 members. There are 3 elected by the banks, representing banks, 3 elected by the banks that represent commerce at large, and 3 selected by the Board of Governors to represent the public at large.
Okay. And the Board of Governors, how are they selected? They're selected either by Congress or by the banks, or how are they selected?
The Board of Governors in Washington are appointed by the President and confirmed by the Senate.
Okay. So in
All
Washington.
7.
So the 7.
Yes.
How are the presidents? Who selects the president, or how do they become the president of the banks? Say Kansas City. We talked about the Federal Reserve of Kansas City.
They're selected by the Board of Directors, but approved by the Board of Governors in Washington.
I guess where I'm trying to understand, there is a confirmation process in the Senate of all the governors, or
Yes.
just some of the governors?
All the governors in Washington.
And then, but there aren't 12 governors, there are only 7 governors.
Correct.
And all of those, we have 2 openings right now.
That's right.
And their terms are how long?
14-year terms, and they're staggered to expire every 2 years.
The presidents, remind me again, how are the presidents selected?
The presidents of the reserve banks are selected by the Board of Directors of the Reserve Bank, but then with the approval of the Board of Governors in Washington.
Okay. Let's go back to Ms. Bachman's questions on 13.3.
Yes.
Explain what it takes to have an action taken in unusual and exigent circumstances under 13.3.
So under 13.3, the Federal Reserve Board may authorize a reserve bank to make a loan if, by a vote of at least 5 members of the Board of Governors in Washington, the board determines that there are unusual and exigent circumstances. They direct the Reserve Bank to make sure it's secured to its satisfaction, and the Reserve Bank then has to collect evidence that other credit accommodations aren't available to the borrower. In those circumstances, the Reserve Bank can make a loan.
Did that occur with the Bear Stearns assistance?
Yes, it did.
I guess I recall the action being taken, in which I felt personally was very unusual for the Federal Reserve, and it's borne out by your testimony that it had never happened except for maybe back in the 30s.
Right.
Can you describe sort of the process that happened to get that done? Did it happen over a week's period, 2 weeks period, a day's period, 22 hours? I mean, how did you get all 5 guys together, or gals, or guy? What is the makeup of the board, the 5 that exist today?